It is time for us to subtract out the others from Company A so we can go from their income from operations ultimately to their bottom line, their net income. What others do we have according to our information? Well, let's start with revenues and gains. We have two of them. We have the dividend revenue that we got from our equity investment in some other firm, and the gain on investment sale that we had from selling that said equity investment in another firm. We had $10,000 of dividend revenue and $90,000 of gain on investment sale. So I'm going to go back to my template and fill in those two line items. We have dividend revenue, like the type, that would be outstanding, and we have gain on investment sale. We're going to put these two numbers in the middle column. I'm going to hit equals. I'm going to go back to my information. I'm going to find that, and we see we got $10,000 of dividend revenue and equals the $90,000 gain we experienced on investment sale. If we add those two numbers together, equals 10,000 plus 90,000, we see that Company A had $100,000 of other items outside of their normal course of operations, which is ultimately going to bring up their net income. So what I'm going to do now is I'm going to go and I'm going to add the $7 million of income from operations to that $100,000 in other revenues and gains we had, and come up with a no-name subtotal of $7.1 million. I don't know why the no-name subtotal shows up on income statements. It just does. It's basically saying that had we not had any other expenses and losses or any of that type of jazz, we would have had $7.1 million worth of income from our continuing operations. However, we did have other expenses and losses. If we go here, we see we had two. We had a massive casualty loss from the break-in and theft of our showroom, and we paid $20,000 in interest on our notes payable. So let me go and fill in those two line items. We had 405, a casualty loss, and we had interest paid on our notes payable. To the center column, let's bring those numbers over. It was a $580,000 loss and a $20,000 interest payment on our notes. So in total, if we add those two numbers together, we had $600,000 of other expenses and losses, which ultimately has to decrease our taxable income. So I'm going to go and I'm going to subtract that $600,000 from the $7.1 million no-name subtotal we had, and we see that our income from continuing operations before we account for income tax is $6.5 million. We have one more thing to do in this section. It tells us in the information up here that our showroom was the victim of an unfortunate break-in, caused us to incur a significant loss, and the company would like to disclose this information in the notes to the income statement. Well, we have an A and a B. Let's call this C. I'm going to put it right next to casualty loss. And it's probably going to change to the copyright symbol. It sure did. That's perfectly fine. You can leave it that way. We're not copyrighting casualty loss, but Excel likes to format that way. And we have a C down here, conveniently, that we can use to disclose to users of our information exactly what happened that caused us to incur that casualty loss. So we're just going to write a brief little blurb that lets people know. I'm going to say that during the period, Company A's showroom was broken into and vandalized. The reported casualty loss is net of the insurance proceeds received from the insurance settlement. As long as what you write matches the substance of what happened, I will never take points away from you for grammar or anything else. And here we're in an accounting class, not an English class. If you just simply said, Company A's showroom got broken into and was vandalized and they lost tons of money, I'm perfectly fine with that too. But that's our note. Now people who look at that are like, wow, that's a huge casualty loss. What happened? They have that information that lets them know. back to where we were, moving our way down the income statement, we were at income from continuing operations before income tax. And the line that we have filled in underneath is income from continuing operations. Well, if we have before income tax and it doesn't say anything here about tax, what do you think we have to subtract? Our income tax expense. And if I go back to our information over here, we don't have a line anywhere that says income tax expense, but we do have a note right here that says Company A pays a 20% tax rate, which means if we're paying a 20% tax rate, we're going to have to pay 20% tax on that $6.5 million in taxable income we had from continuing operations. So I'm just going to equals, click on that 6.5 million, and multiply it by 0.20. That is $1.3 million. We will have to pay $1.3 million to Uncle Sam, our local government, etc., in the form of taxes on that $6.5 million we made. So after we make that tax payment, we cut that check to the IRS or whomever. We'll have $5.2 million left over that came from our continuing operations. But we discontinued operations. We had a gonculator division that we decided to get rid of because it was operating at a loss. And we see down here that operations led to a loss of $200,000 on that division during the period. We got rid of all that stuff and we took a massive loss of $1.3 million. In total, that's going to lower our reported net income by somewhere in the vicinity of $1.5 million. But we want people that are using our information to know that that's not going to happen every year. We're not going to have this huge loss from the gonculator division. We decided as a dud, we're going to get rid of it. So we're going to report that in our discontinued operations. There's always two parts to it that you have here. It is firstly the income that came from operations of that discontinued operation. In our case, it's the gonculator division. And whenever you report income or loss or gain or whatever from a discontinued operations, you report it net of its applicable income tax. Like all of the results of what happened with this would have been included in our income tax expense. Well, we got to get rid of this. So we're going to, from that, subtract applicable income tax. So what was our income from the gonculator division? Well, there wasn't any. It was a loss from the gonculator division of $200,000. I'm going to throw that number into the leftmost column. 200,000, bring it on over. That loss that we incurred from the operations in that division, however, reduced our taxable income, which means that we saved on taxes we would have had to pay if we had previously discontinued the gonculator division. So we need to offset the actual amount of loss that we're realizing by how much it saved us in taxes by being able to report that on our income statement, on our federal tax filing. Well, our tax rate, we already determined up there, was 20%. So if I multiply this by 0.20, I come up with 40,000. We do have an issue here, though. This didn't reduce like the overall loss that we had. We're not going to lose $240,000 here. That $40,000 is tax savings. So if we report it net, we want this number to be positive. So I'm going to go back into the formula bar. I'm going to make one of the inputs negative. I don't care which one. We get 40,000. What we're saying here in this cell is that we lost $200,000 of operations, on operations of that discontinued division. But it saved us $40,000 during the period in our taxes. So the total offset effect of this is that gonculator division's operations reduced our reported income by $160,000. We're going to do the same thing with the loss on disposal of the discontinued operation. Loss on disposal of the gonculator division. The loss that we had, which is massive, was $1.3 million. We sold all the equipment that we used to build gonculators. Apparently nobody wanted to pay a high price for it. We sold it for $1.3 million less than our books said it was worth. Thankfully, at least we got to use that as a loss on our tax filing to reduce the amount of tax we had to pay. So we need to also offset this guy by its applicable income tax reduction in this case. And that is going to be equal to 20% of the loss. Being able to reduce our taxable income by $1.3 million and paying a tax rate of 20% means that that loss at least allowed us to save $260,000 in taxes. Again, this number we want to have as positive. So I'm going to go back in the formula bar. I'm going to put a negative in front of the tax rates, and we come up with 260 grand. So what does this mean altogether? Well, we took a $1.3 million loss on the disposal of the assets of that calculator division, but that loss at least allowed us to save having to pay $260,000 in income taxes. So net of the applicable income tax reduction, the total effect that getting rid of all the assets of the calculator division had on our profitability for the period is it lowered our overall income by $1,040,000. Now, if I add together the $160,000 that we lost, I guess, from operations net of tax with that calculator division, and the little over $1 million that we recorded a loss for the disposal of that division, I come up with $1.2 million to the bad. That calculator division in its last year of operations and getting rid of all the assets associated with that calculator division lowered our overall reported net income by $1.2 million. So if we had $5.2 million of income from things we're going to continue to do in the next period, but we lost $1.2 million from this operation, which we're discontinuing, we're not going to do in the next period, during this period, our net income should be $4 million. I will be honest with you, on most income statements, all of these numbers are recorded as positives. In this course, I've had a bit of an issue in the past with people working the tax the wrong way, or, subtracting out a gain, adding in a loss to income. For the items in here, really think about what that would do to your income in the long run. If you had loss on here, that has to bring the number down. And if you have a loss, at least it saves you on taxes, so you would have to offset. If you had a positive, we'll say gain down here, and it would be bringing your income up, that tax reduction would at least reduce it. So you always subtract out the tax. And for the other things, think about what effect it had in the long run on your income. In our case, we have $4 million of net income. Unfortunately for our shareholders, they're not entitled to that full $4 million. Why is that? Because this bullet point right here says that we don't wholly own one of the subsidiaries. We own more than half of it, which means we need to consolidate their accounts, their financials, into our financials. So that $400,000 in income that Hogan Gadgets had is going to get rolled into all of Company A's income. But since we don't own all of Hogan Gadgets, our shareholders are not entitled to all of that $400,000. We need to reverse out the portion of that $400,000, which is already included in our net income, that our shareholders can't get at. How am I going to do that? Well, you can do that as such. We have $400,000, we own 75%. If I go here, I can say this equals that $400,000 in income that came from that Hogan subdivision. Then if I multiply it by 1 minus the rate that we own, I get the rate that they own. They own the other 25%, and therefore if they own the other 25%, they're entitled to 25% of that $400,000 of income the Hogan subdivision made, which is $100 grand. That amount is, you get subtracted out because that is the net income allocated to non-controlling interests. Our passive or minority owners, if you will, of that Hogan division get $100 grand of our income, which means only $3.9 million of that is left over. That is our net income allocated to Company A shareholders. So now our investors, our owners, will look at this and know that, hey, we made $3.9 million that they can get at. But any one person's going to want to know, okay, I only own a couple of shares. What's my portion of that? And that is why GAAP makes us report our EPS.